Welcome to another This Week in Co-working Discussion.
Hey everybody, and welcome back to the This Week in Co-working podcast feed. We're back today with another Behind the News episode. I am your host, Hector Kolonas, and today I am joined by Jason Anderson. Jason, how are you?
Good, Hector. How about yourself?
Not too bad, not too bad. Busy week for everyone in co-working. There was conferences in Dallas, 40-something links in the newsletter, one of which was about the news around the future of Vast Coworking. Instead of me telling the story, Jason, in your own words, what happened this week at Vast?
Sure. So Vast was kind of an idea that really spun about 12 years ago. I was able to write a book, and I think we've talked before on how to franchise your business. And one of those concepts we turned into a franchise was Venture X. Very quickly in doing that, we looked at who the competitors were. And the two main competitors at the time were Office Evolution and Intelligent Office. There were a few other people that were there, and some of them have now went a different direction outside of franchising, but those were the two kind of long mainstay brands. And a crazy idea came up with our board that, why isn't there a Marriott of co-working, kind of combining all these brands underneath one umbrella? And that's what we've been able to do over the last decade. So with the acquisition of Intelligent Office 2 years ago, we purchased them from a private equity firm. The questions kept coming up. Really, what's next for Vast, right? Now that we formed Vast, how do we kind of get to that next level? The founder of United Franchise Group, personal friend of mine, and mentor, Ray Titus, he started Sinorama 40 years ago in Long Island. So all his family has ever done is franchising. His father started the Minuteman Press franchise. All of his kids and nephews work in the business. I'm still currently right now in the building. So it was kind of bittersweet when we discussed with the board that really to get Vast to the next level and compete with the multi-billion-dollar companies that we're competing with, the Reguses of the world, Industrious now backed by CBRE, WeWork now backed by Yardi, that we needed more resources, right? So there was only a couple logical options: go public or private equity, right? And that seemed like the right path to kind of help get us to the next level. So conversations started about 2 years ago, really heated up about 18 months ago, kicked into high gear 12 months ago, went into an insane amount of due diligence 6 to 9 months ago, and here we are today, right? So we narrowed it down to the partner we have now, New State Capital Partners out of New Rochelle. Moving forward, right? So this will be a true carve-out from United Franchise Group. My entire team, all my same people are staying with me. Several I've got promotions and they're coming on board. We're still contracted with UFG for some additional services and resources that we may need through the transition. But it will be a clean carve out of Vast Coworking Group as a standalone entity on its own. So a good validation of the work the team has done, over the 11 years to get us here. Intelligent Office is 31 years old this year. For those that don't know, that was such a good idea that the founder of Office Evolution started Office Evolution out of Intelligent Office. And then Venture X was built out of the need and desire of WeWork or other brands not wanting to come to Naples. So it's been a fun journey and excited for the next continuation of our world domination plan.
Love that. And we're seeing a lot of private equity interest around the co-working world, both on the franchise side and in just traditional co-working and membership clubs. I think we had a news story this week about Blackstone investing 100 million pounds into a membership club that was family friendly. So we're seeing this interest in the private capital markets towards our industry. So you said this has been in motion for about 11 years now. You're at around 200 locations worldwide, I believe, at last count.
So yeah, we're over, but this month we're probably getting close to 215. It's 215 right now.
That's impressive numbers. So my question for you is, obviously, this has been the plan for a very long time. Why now, Jason? Why in 2026? Why the first quarter? Is it just that it happened to be when the deal closed? Or is there something that you're picking up in the market that you wanted that extra capitalization to take advantage of?
Sure. So kind of a multi-layer question. The first thing I'll tell you is we may have discussed or we talked, I tell a lot of people of my historical view of where co-working is today, right? What I feel right now is we've emerged into co-working 4.0. I can give you where I think the previous was if you want me to spend a couple minutes doing that, or I can go
Please.
straight into. So co-working 1.0. I consider co-working 1.0 Regus. I've had a chance to meet Mark Dixon, really cool guy, right? I started my business out of a Regus in Dallas, and I really credit Regus with all of co-working 1.0. So co-working 1.0 is really this executive suite model, right? It's where people didn't really understand it at that time, like, who used this? Were you really a real business if you did this? But for all intents and purposes, there's you could Google, if you're a co-working nerd like yourself, maybe somebody else did it first, but like Ford modernized the assembly line. I credit Regus as co-working 1.0. Co-working 2.0 is WeWork, right? And let's just estimate they came on the scene around 2010. So Regus is from about mid 80s to 2010. That's all of co-working 1.0. To me, WeWork is co-working 2.0. The reason I say that is WeWork started around the same time frame as Tesla. And WeWork did to co-working what Tesla did to electric vehicles. These things existed, but they came in and made it cool. It's what the hipster kids wanted to do. If you were in Brooklyn or New York or London, it's like, oh, this is the place you want to be. It was about community, and they're going to change the whole world. And even for their ups and downs, John Santora, the current CEO, and obviously Yardi, the company is now private and profitable. So the joke is even WeWork couldn't mess this up, right? I've never had a chance to meet Adam Newman, but I think that story will be studied in MBA classes as the most spectacular way to fail your way to become a billionaire almost in the United States, right? It's a modern marvel of American business history. So Regus 1.0, WeWork 2.0, the pandemic is 3.0, right? That's where I had just moved to Dallas, Valentine's Day 2020. VentureX was going great. We signed like 60 locations in 2019. March 2020 happens. I joined the military July 2000. I planned on doing 20 years. The year after that, 9/11 happened. That changed my trajectory. I'm like, well, that can't be good. Like, right, active duty military, 9/11 happens. I got my real estate license in 2007. Next year, Great Recession happens. That created the opportunity that led me to franchising and selling my real estate brokerage. We acquired VentureX 2019. Next year, the pandemic happens. So I'm like, oh man, I've kind of been through this rodeo before. It kind of just is what it is. I'm a go with the flow type person. We'll figure it out. I'm like, is the whole thing going to go away? I don't know. We'll do something with the spaces we have now. The decline started to happen around April, May, June. Numbers started going down. But by August or September, the industry got together and the industry was deemed an essential business, right? Which is a term nobody used before that, and nobody really uses it now. But that meant we could not close because of commercial mail. By October, November, the numbers started going up and they have never come down. It created the largest work from home experiment, and companies realized, wow, a huge chunk of people don't need to come to an office. We can save some cash. Like the Allstate news, the T-Mobile news with Liquid Space, they're sending 25-30% of the people home. 25-30% are going to stay in corporate towers, and 25 to a third are going to go into co-working. So that's co-working 3.0, the test of the pandemic, the largest work from home experiment in the world, and then people wanting to be working closer to home and some of the decline of the urban CBD markets, which has led to co-working 4.0, where we're at right now, which you could peg that whatever date you like to peg is really the finalization of the pandemic. Let's put it mid 2023 to about beginning of 2024. We acquired Intelligent Office in January 2024, right? So that created where we're at today, which I think is flex first, in the sense that it's like the transition. And I've said this on a couple other podcasts or outlets, like from taxi to Uber. Nobody knew they needed Uber. And, kind of what sucked for taxi companies was great for Uber and really the consumer. Like, right, it's just a better way to do something that existed. So now I believe we're in the period where it's not, this is hipsters, it's startup businesses, it's class, coach business class. It's now enterprise adoption of flexible office space, right? So the hipsters are going to do it. Small, medium businesses are going to do it. We're going to have a new genre of clientele that never has the privilege or experience of signing a traditional lease. It kind of doesn't make sense. We're talking with, a lot of different companies and people we can't name who may completely go out of their retail storefronts and be 100% into co-working. You have a page on the GSA website for commercial governmental co-working. right? It's just a better, more efficient, cost-effective way to do something that's already existed. And that's created the opportunity that we live in today. And what I like to say is private equity firms kind of just follow the money, right? If you have to look at who has made investments in the last 2 years that if you could bet your money with other smart people, you would make bets on. The first would be CBRE, right? The world's largest commercial investment firm. You have to imagine they know a lot about commercial real estate. They're a 120-year-old company headquartered in Dallas, and then their bet on CBRE twice, right? They tried to do it themselves. Hana didn't make sense. They made a first investment into Industrious during the pandemic, and then the furthering of that with their complete acquisition in 2025. That's hard to not notice. If you're a PE firm, if you're an investor, wow, what do they know? Like, right? They know a lot, right? They have a lot of access to data. To me, a real seal on it, though, is who I consider to be the single most knowledgeable human being on earth for commercial real estate. Anit Yardi, like, right, just one of the nicest human beings anybody could ever meet. Self-made billionaire, 40-year-old company. He wrote the original code for it, still running it like he's in his 20s today. But if you had to peg who has access to the most amount of data as a single human being, I think that would be Anit Yardi. I mean, I don't know who else would, literally speaking, be a person that wrote code, understands numbers, has behind the scenes. And spoiler alert, he purchased WeWork, right? And in short amount of time, John Santoro brought some adults into the room and has turned WeWork private and profitable. I believe they've sold out again in New York City. It went from, again, HBO series with Jared Leto and Anne Hathaway, which is just an awesome story, a great movie, to being private and profitable and still a going concern. Like, right, even through that, there's We Crash, HBO show, podcast, books written about it. It is still here. They are still going strong kind of through that. So you take that into perspective, that garners a lot of attention. And we were fortunate to kind of be in the right place, right time, having amassed the three largest co-working franchise brands combined kind of in America. We do straddle somewhere between the second largest, which I believe we are by number of pins on the map, right, to the third. Industrious is close there, and that's domestically, right? I believe we have more locations open. Now, if you get to square footage, they'll have bragging rights. So now to compete with the billion-dollar players, we needed a billion-dollar partner, right? And we needed to kind of be our own standalone ecosystem, and that's where New State Capital Partners comes in, and they saw the vision and the dream of that kind of continued development of growth. We've been able to successfully build an American franchise ecosystem. Other partners have built great international franchise ecosystems, but doing it in America is different, right? It takes a little bit more energy, resources, and effort, time than selling off specific countries. And here we are today. So that's a lot of words, maybe, but that's my assessment of the co-working industry. I think it's the right place, right time, a lot of opportunity for everybody. And as these companies continue to cut 20, 30, 40, 50, 60, 70, 80% of their traditional office, there's just not enough space to fill that demand, right? I mean, it's basic demand and supply, right place, right time, historical growth. The technology is catching up, right? With Yardi, Flex Space, several other providers, that the technology and e-commerce is catching up to the demand. Liquid Space building portals for enterprise users, WeWork enterprise apps, single biller platforms. It's the right time. That's just it.
Completely agree, and I'm very, very biased given that I write a newsletter about co-working every week. So I completely agree with you, but the numbers are there. And just to go a little bit deeper into the supply and demand issue, is that even if the big number that we float is 30% of real estate becoming flex, if 30% of businesses turn tomorrow to flex, we don't have enough co-working spaces. There isn't enough seats to place those people, even if we oversold the desks 3-1. Right? So there is this huge opportunity just sitting there. So I completely agree with you on that point. The one thing I'll disagree with you is kind of the gap between version 1 and version 2. There is a whole bunch of innovation that happened between IWG and WeWork, but I can understand the overarching narrative changes from IWG to WeWork?
Well, I completely agree, and that's why I prefaced it. And I actually said, if you met before, like, for the co-working nerds, which I'm one of, like, there's, so I guess this crowd is the co-working nerds, is that there is a lot of other things and sub bullet points underneath that. But right, for the general public that
Yep,
doesn't know and understand, that wouldn't make sense. So like I tell people,
absolutely.
even says we focus on four main KPIs. There could be 10 sub bullet points under those KPIs, or just make up the things that you want underneath there. But for
Yep.
general understanding, right, that would probably be, I would defend as accurate. But you're right. You're talking 86 to 2010, right? So that's
Quite a stretch.
a lot been in the world in that time frame. But for simplification purposes,
Yep.
that's yeah.
Appreciate you clarifying that. So what I'm going to do is I'm going to ask you a little bit more about the deal. Now, obviously, in the press releases, you have not said what the total valuation is. I don't think you're at liberty to say. So I'm going to kind of avoid that. What I am going to ask is, what are the other terms? Obviously, you have private equity backing. Have they given you lines of credit to grow, invest in technology, expand, do more marketing? Like, what was the thing? Because you said you've needed more capital. Where do you see that capital going? And how does it change the way that maybe Vast works today?
Twofold, right? Interesting concept, right? The kind of the old line is the best time to get money is when you don't need it, right? So the truth is we wanted access to resources, people, Rolodexes, more so than we needed some hard set capital. So I think that's something that attracted a lot of the people that came to the table looking to partner with us. So there was not some immediate big expense or something that we have. Like we've been running a lean, profitable organization, pretty much since we've launched. So there wasn't the case where it's like, oh, look, we got to do something immediately and kind of buy this, or we need this investment. We have good tech partners and they're building their platforms. We have successful franchisees. Where it really came in is like branding, marketing, people, office space, and kind of just taking the ecosystem that we have right now and fine tuning that, right? If anybody's ever met with PE analysts and due diligence, it is different, right? I mean, it is different. It's extensive to a way. I've got a master class on PE in the world of high finance over the last year. The thought process, the due diligence, the accounting, the reporting, to make it through that process, I think is a great validation of anybody that has done that. But now, like I said, I think we could deploy resources with people, right? Kind of adding some people to the team. So there'll probably be a few new faces over the next, 6 to 9 months, keeping everybody currently on the team, but bolstering some additional resources from a human capital perspective. Consultants, from things from marketing to branding to go to market strategy to kind of polish up the things that we have online, our online presence, our physical presence, our PR, kind of just bolstering that. I think Industrious and some of the brands WeWork have done a great job in kind of rebuilding their online presence and some custom platforms, e-commerce kind of aspects, really bolting onto that. So it's more just foundational infrastructure, ecosystem, people, resources. We've been operating and growing and building under some shared service pools of people. And then having somebody that could be dedicated and focused with inside of Vast, I think is going to really help us over the next 12 to 24 months. But we are going to grow, right? We're still looking at other concepts, brands, ecosystems, acquisitions, both domestic and global, and having those resources there to do those quicker and larger is going to be helpful.
Yep.
And we just simply outgrow UFG. UFG has 11 brands, 1,800 franchisees. I still go to church with Ray. There's no bad blood here. It was a win-win-win, right? And that's what we were looking for. It was a win for United Franchise Group. It was a win for Vast. And a lot of franchisees behind the scenes were involved and knew what was happening. It's a win for them because there may be some opportunities for them to get access to capital, for them to do acquisitions. We had a franchisee that just acquired a brand out of Dallas. So we've switched gears from us acquiring brands to now we have franchisees that are great partners in our systems and they're buying concepts and brands. So we're going to pretty aggressively, I know we did some ads with you, kind of go to market as kind of a go-to solution for any mom and pop operator or local brand that's looking to either partner, divest, grow, build, I think we're a great option for them to partner with and leverage resources and ecosystem. So we're going to be looking to expand that way.
And it was where I wanted to take it next is, have you been given a shopping allowance, right? There are a bunch of new emerging franchises all around the co-working world, both here in America, in the UK, and out in APAC, where there's already clusters forming, vast-like clusters. Do you think there's going to be some form of further consolidation? Obviously, you've got your eyes on things, but have you got a time frame as to how quickly you're looking to acquire other franchises or other brands?
I mean, that the other day we're just talking about, I mean, that happened 30 days ago. Like, right. So the truth is conversations are happening right now. With anything in the PE world, you find the right deal, the money is there. Like, right. So as far as kind of direct allowances, once you kind of step foot into that world, you look at the numbers that CBRE and Yardi has and some of that. The problem becomes is a lot of the co-working operators, since this industry hasn't established direct multiples, it's not like fast casual food and franchising. Some people are just kind of outright delusional, like, right, on their brand or ecosystem. It's like, hey, we have 4 locations in Oklahoma and we think it's worth $40 million. It's like, well, where do you even come up with this number,
Yeah.
right? So there's some aspect of reality setting in, I think, into the industry. But yes, I do believe there's going to be even further consolidation. We could do deals right now if the right opportunity is there. I think there's a ton of opportunity internationally with brands that have been around for 10, 15, 20 years, and they're looking for kind of partnership opportunities, leveraging ecosystem. Even the perceived value of reciprocity, and I use that term in a literal sense, is a value driver to members in the same way it is in fitness, right? So if you can join a random one-off mom and pop gym, but they're probably going to charge the same amount as Planet Fitness, Anytime Fitness. A nice gym local is probably get you get to lifetime and 24 hour. It's like even the perceived value that you have this extra ecosystem is a value.
Yep.
Right? So that aspect is becoming increasingly hard for mom and pop competitors to compete with, and then combined marketing resources, right? So,
Yeah.
I've looked at some operators that, their marketing is 15, 20% of their total revenue because they're the only ones doing it, right? We're able to combine smaller percentages of 200 locations, right? Which just gives more bandwidth out of the same dollars, right? So obviously we're going to get better deals typically with vendors at location number 220 than mom and pop operators can get on location number 2 or 3. So even
Yeah.
partnering with us for opportunities, and then there's just going to be a huge conversion of real estate, right, with the landlords. Our other big approach is we can be an end-all, be-all solution for landlords. And let me kind of explain that. To my knowledge, and I say these things because outside of you and a handful of people, nobody's keeping track of this information, right? So I kind of tell people most of the things that what I'm saying here is based on a true story of my belief, right? That we are the largest current co-working operator doing traditional leases. Like, so, and I'll say that again, and
Yep.
by all means, anybody could prove me wrong on that. But from my knowledge, our franchisees, our ecosystem is signing more traditional leases than anybody currently is in America, right? So you look at Regus no longer doing them. Right, they're only doing managed service agreements. So that takes Regus off the table if you're a landlord for a traditional lease. Industrious is doing hybrid leases, right? So it's a hybrid mix, some investment into the space. You remove those two, who else is left doing traditional leases, possibly at the scale and size and scope? We may put 45 to 60 locations on the map this year, and the bulk of those are going to be traditional leases. So the first side of it, if you're a landlord and you prefer a traditional lease and you have between 2,500 and 50,000 square feet, we have brands that fit those size ranges and franchisees willing to do traditional leases, right? So from a landlord perspective, we're getting a lot of inbound calls now at this point from landlords that don't want to do the other models. But let's say they want to do a hybrid or managed service. We can do hybrid or managed service, meaning by we, my local franchisees, who some independently on their own are in the 20 largest co-working operators in America. We have several franchisees that own rights to 20 locations and they have 12, 13, 14 open, right? We have franchisees that are opening 5 or 6 locations a year. So on their own, they're independently large operators.
Yep.
And they're now coming in doing hybrid and managed service agreements. So from a landlord perspective, we can do traditional, hybrid, managed service. We can go from 2,500 square feet to 100,000 square feet. So we are getting ourselves out there as a go-to solution, regardless of
Yep.
which type of deal they're looking to do, which
That
makes
is
us
re-
unique.
that is really interesting. And obviously, you started us off by talking about the Marriott approach, having multiple flags, multiple brands, different quality levels, sizes, etc. Will Vast forever be a franchise business, or will you ever fully own and operate spaces? Because there are, as you said, operators who are looking to sell 10, 15, 20, 30 locations, but they don't want to be franchisees. Like, what is your strategy for that? Will you absorb brands and turn them into franchises?
So that's what we just did in Dallas, right? So there's two ways existing. There's really three. There's the main two ways, though, that an existing operator could work with us. One would be a conversion, which probably isn't that likely, but there's some people that may want to do that, right? So, like, if somebody owns one space, 5 spaces, 10 spaces, and they're like, hey, look, we've been building this and, you know, we still want to stay involved, but we want to grow and develop and kind of plot out an exit strategy. We can work with them on doing a conversion into one of our brands or multiple of our brands, right? I've met operators who started 20 years ago and their first location is 4,000 square feet and they now have a 40,000 square foot managed service agreement, right? So like but it's called the same thing, right? In our ecosystem, that may be an intelligent office, an office evolution, and a Venture X. So we could work with them on doing conversions, meaning they convert their concepts into our brands. And the reason somebody would do that is they may instantly maybe lower their marketing costs or expense. They now have a training ecosystem. They have an operations manual. They have a lot of the infrastructure. If they sell that, now instead of somebody buying Hector's co-working, right, which everybody may love Hector, right? So everybody loves Hector, but they're like, hey, where's Hector? Hector's not here anymore, right? So it's now they have a brand behind that that's 14, 20 plus or 30 plus years old. There's a training ecosystem, there's marketing initiatives, there's a team behind that. It could possibly help them increase the value in 1 year, 2 year, 3 years if they try to sell that. So they can convert, hold for a little bit, sell, possibly get a little bit more opportunity. They could sell a portion of that or the whole thing. Another path is yes, they can come to us. We'll help evaluate the brand. We do what we call a resale marketing agreement, right? Where we do like this non-exclusive thing. Hey, look, no harm, no foul if we can't put a deal together. The deals we just did in Dallas, this is how that came about. Met the co-working brand and they're like, what's the options? We're like, option I just laid out. Second option is, we don't currently want to run brands directly and compete with franchisees. So Vast has had corporate stores. We've since sold all the corporate stores to franchisees. So my team focuses 100% at this point on helping the franchisees be successful. We're not looking currently to come into markets and compete with them. So the second side is we package it. We do a resale marketing agreement. We get the numbers, the financial, get an understanding of what the owner is looking to do. And then we present that to our ecosystem, starting with our existing franchise base, which is about 180 franchisees. But I have 60,000 people have inquired about owning one of our 3 concepts. So the first go-to is our franchise advisory council for each brand. They kind of get first dibs. They see it. They let us know if they think, hey, look, these locations make sense. We would rubber stamp that. This could be an OE. This could be a Venture X. This could be Intelligent Office. Then we send that out to our franchise ecosystem. Every one we've received, we've actually had somebody make an offer. Every deal that somebody has came to us that our initial team reviewed and approved and we've sent, there has been an offer made. Now, obviously, not all of those deals have closed. Some of them are still pending. But truly speaking, if the brand has been around for 3, 4, 5, 6 years, whether they're profitable or not, we have had some form of option or opportunity presented on every one we've ever submitted. Because at the end of the day, I'm not going to present something to my franchisees that I don't think is the right opportunity. So we're cherry picking, I guess. So, to kind of preface that, I'm able to cherry pick the front side. But That's how we do it, right? We're using old school due diligence. I tell people I've been a real estate broker for 19 years. You should never do an investment property based upon how much money can you make flipping a house in America. It's not a really useful search term, right? You got to do the due diligence on each brand, each space, each property, each address, not the zip code, not the building, not just looking online. So we do real kind of extensive traditional real estate due diligence on every single location and property.
I mean, we could have a whole episode just on what does the market look like for buying, selling, reselling co-working spaces in and outside of franchises. So we'll probably get you back on the podcast to talk more about that in the near future. I know this is your third time you're joining us here. The first time was with Anant Yardi. Second time was talking all about franchising. Thank you for joining me today to talk about this news. And I'm pretty sure we'll speak again on the podcast to dig a little bit more into the business of selling businesses. Jason, thank you again for your time. Appreciate you carving some time out with us to talk about this carve out. And I will speak to you and see you soon in person somewhere soon.
Thanks, Hector.